What I'm about to share with you, I probably shouldn't be saying this publicly. There are conversations that happen behind closed doors, in quiet rooms, with people whose decisions shape the global economy. And for most of my career, those conversations stayed there. But right now, something is different. In my 40 years in finance, I have never felt this level of unease about what's coming next. I've seen crashes before. I lived through Black Monday. I watched the dot-com bubble inflate and explode. I was there in 2008 when fear froze the global financial system almost overnight. Back then, the warning signs were subtle. Today, they're flashing in bright red. And yet, most people are going about their lives as if nothing is wrong, commuting to work, scrolling their phones, trusting that the system will somehow take care of them. Let me tell you something most people don't understand. Financial crises don't announce themselves. They don't come with sirens or headlines that say, "Get ready." They arrive quietly, then suddenly. One day, everything looks normal. The next day, doors are closed, credit disappears, jobs vanish, and people are left asking the same question. How did this happen so fast? I'm telling you right now, the wealthy are quietly moving their money. They're not panicking. They're not shouting. They're preparing. And the reason they're preparing has very little to do with what you're seeing on the evening news. The media won't tell you this, but when markets look calm on the surface while stress is building underneath, that's when you should pay the most attention. When I sit in rooms with billionaires, here's what they talk about. Not stock tips, not headlines, not the noise you see online. They talk about fragility. They talk about debt levels that can't be sustained. They talk about governments trapped by their own promises. They talk about a system that has been pushed too far for too long. And lately, the tone of those conversations has shifted from theoretical to urgent. I remember back in 2006, people told me I was being overly cautious. Housing prices only went up, they said. Banks were smarter now, they said. Risk had been engineered away. We all know how that story ended. Families lost homes. Retirement accounts were cut in half. Years of hard work disappeared in months. And the worst part, most people never fully recovered. What's coming next won't look exactly like 2008. History never repeats itself perfectly, but it rhymes. And I've seen this pattern before. Easy money, rising debt, asset prices disconnected from reality, and a deep belief that this time is different. It never is. It never ends well. You might be thinking, Larry, if this is so serious, why is everyone acting so normal? That's exactly the danger. The most painful moments in markets come when complacency is highest. When people believe risk is gone, when they're encouraged to stretch, to borrow, to speculate, because nothing bad has happened recently. Here's what the wealthy do that the middle class doesn't. They don't wait for confirmation. By the time the headlines turn negative, it's already too late. They prepare when things still look fine. They ask uncomfortable questions early. They protect before they chase. And right now, they're asking one question over and over again. What happens if confidence breaks? Confidence is the real currency of the financial system. Not dollars, not euros. Confidence. Confidence that money will hold its value. Confidence that institutions will function. Confidence that tomorrow will look roughly like today. Once that confidence cracks, events accelerate in ways most people can't imagine. Most people make this critical mistake. They assume that because they don't see immediate danger, there is no danger. They confuse stability with safety. But stability built on excessive debt, political pressure, and financial engineering is not safety. It's a setup. I'm not saying this to scare you for attention. I'm saying this because I've reached a point in my life where staying silent would be irresponsible. I've benefited enormously from this system. I've built my career inside it. And precisely because of that, I feel a responsibility to speak plainly now. What I'm about to share in this series could change your financial future if you're willing to listen without denial. This isn't about predicting the exact day or month something breaks. That's a fool's game. It's about understanding direction. And right now, the direction is clear to anyone who's willing to look beneath the surface. If you're someone who works hard, saves diligently, and hopes the system will reward responsibility, you deserve to understand the risks you're actually facing. You deserve more than sound bites and slogans. You deserve the truth, even when it's uncomfortable. And if this channel exists to bring clarity in times of confusion, then staying with this conversation matters more than ever. Quiet preparation today is what protects dignity tomorrow. Because here's the part that should really concern you. The next crisis won't just hit Wall Street. It will hit pensions, it will hit housing, it will hit jobs, it will hit confidence, and once it starts, there won't be time to figure it out later. So, before I explain why this is happening, before I show you what I'm seeing that most people aren't, ask yourself one honest question. If the world changed faster than you expected tomorrow, would you be ready? I've been in this business for over 40 years, and I don't say that lightly. 4 decades of watching money move, power shift, confidence rise and collapse. I started my career at a time when trades were written on paper and risk was something you felt in your gut, not something hidden behind algorithms and spreadsheets. I've lived through inflation, deflation, bubbles, crashes, bailouts, and recoveries. And every one of those moments taught me something the textbooks never could. Today, I serve as chairman and CEO of BlackRock. We manage over $10 trillion for governments, pension funds, insurance companies, foundations, and everyday investors all over the world. That number isn't just large, it's influential. It gives us a vantage point few people ever see. When capital shifts, we see it early. When risk builds, we feel it across markets, countries, and asset classes long before it shows up in headlines. When I sit in private meetings with central bank governors, heads of state, and finance ministers, the conversations are very different from what you hear on television. Publicly, leaders speak in reassuring tones. Privately, they talk about constraints, trade-offs, and limits. They talk about what can't be fixed easily. They talk about systems that are stretched thinner than most people realize. I remember early in my career, back in the 1,980 seconds, I made a mistake that cost my firm over $100 million. It was devastating. I thought my career was over. But that failure forced me to truly understand risk, not mathematically and emotionally. I learned that risk isn't just volatility, it's fragility. It's what breaks when conditions change. That lesson shaped everything I did afterward. BlackRock was built on that principle. We didn't grow by chasing fads. We grew by obsessing over risk, transparency, and long-term thinking. That's why institutions trust us with retirement money, with pensions for teachers and firefighters, with savings meant to last generations. That trust is earned slowly, and it can be lost quickly. So when I say I'm concerned, understand what that means. I'm not someone who benefits from panic. Panic destroys value. Stability creates opportunity. My entire career has been built on the belief that well-functioning markets improve lives. But markets only function when trust exists. And trust right now is being quietly eroded. People sometimes ask me why I don't speak like this more often. Why not sound alarms on television every week? The answer is simple. Words carry weight. And when you've spent your life inside the system, you learn that careless warnings can cause the very damage you're trying to prevent. But there comes a moment when silence becomes the bigger risk. That moment is now. I'm choosing to speak publicly because the gap between perception and reality has become too wide. Ordinary people are being told one story, while a very different story is being acted upon at the highest levels of finance. And that gap is dangerous. It's dangerous because it leaves people unprepared. It's dangerous because it creates false confidence. Let me be clear. I'm not predicting the end of capitalism. I'm not saying the system will collapse and never recover. I've seen recoveries, I've helped build them. But the path between here and stability may be far more painful than most people expect. And pain is not distributed evenly. It never is. When crises hit, those with flexibility survive. Those without it suffer. That's not ideology. That's history. Over the years, I've sat across the table from some of the wealthiest individuals in the world, people who could afford to be wrong. And yet, they are often the most cautious. They stress test assumptions. They plan for scenarios that seem unlikely until suddenly they're not. Meanwhile, the average household is encouraged to do the opposite, to stretch, to borrow, to assume tomorrow will fix today's problems. That imbalance worries me deeply. I'm also at a stage in my life where legacy matters. Not legacy in terms of buildings or headlines, but impact. What good is experience if it's never shared? What good is insight if it only protects those already at the top? I don't believe knowledge should be hoarded when it can help people make better decisions. This isn't about telling you what to buy or sell. It's about teaching you how to think when the environment changes, because environments always change. And those who adapt early don't just survive, they emerge stronger. Everything I'm about to say in the next part is grounded in data we see every day. Capital flows, debt levels, interest rate sensitivity, demographics, technology, geopolitics. None of this exists in isolation. It's all connected. And when enough stress builds across enough systems at once, something gives. You don't need to be an economist to understand this. You just need to be honest about incentives in human behavior. Excess is always followed by correction. Always. So listen to me not as a billionaire executive, but as someone who has watched optimism turn into fear more times than he can count. Someone who knows how quickly the mood can change. Someone who understands that preparation isn't pessimism, it's responsibility. Because once you truly understand what's happening right now, you'll realize this isn't about markets alone. It's about your job, your savings, your retirement, your sense of security. And that brings us to the real issue, the part most people never see, the mechanics behind the calm surface. Because to understand what's coming, you first need to understand what's already happening. What's happening right now looks calm on the surface, and that's exactly why it's so dangerous. Let me tell you something most people don't understand. The financial system doesn't break when things are bad. It breaks when things look fine but are built on pressure. And right now, pressure is everywhere. It's just hidden behind numbers that most people don't know how to read. Start with debt. Global debt is higher today than it has ever been in human history. Governments, corporations, and households have all borrowed aggressively for more than a decade. Why? Because money was cheap. Interest rates were near zero for so long that borrowing stopped feeling risky. It felt normal. It felt smart. But cheap money doesn't remove risk. It delays it. Now rates are higher, not historically high, just higher than people are used to. And that change alone is enough to expose weakness. Imagine someone carrying a heavy load uphill. They can manage it when the road is flat, add a slight incline, and suddenly they're struggling. That's what higher rates do to a debt-heavy system.
Governments are feeling it first. Servicing debt is becoming one of the largest line items in national budgets. That means less money for growth, infrastructure, and social stability. It means tough choices.
And politicians don't like tough choices, especially in election cycles. So instead of solving problems, many are postponing them again. Corporations aren't immune either. Many companies use cheap debt not to innovate or become more productive, but to buy back shares and inflate earnings. That worked when borrowing costs were low. Now refinancing that debt is expensive. Margins are shrinking. Layoffs become the easiest lever to pull. and ordinary workers pay the price. Then there's the consumer. For years, people were told low rates were a gift. Buy the house, upgrade the car, carry the balance. And millions did. Today, credit card debt is at record highs. Auto loan delinquencies are rising. Housing affordability is stretched to extremes. People aren't spending because they're confident. They're spending because they're trying to maintain a lifestyle that inflation quietly eroded. Inflation is another part of this story that's deeply misunderstood. Even when headline numbers come down, the damage has already been done. Prices reset higher, but wages rarely catch up. That gap creates frustration, anxiety, a sense that no matter how hard you work, you're falling behind, and that emotional stress eventually shows up in economic data. Now layer on demographics. In many developed economies, populations are aging. Fewer workers are supporting more retirees. That puts enormous pressure on pension systems, healthcare, and government finances. This isn't a theory, it's math, and math doesn't negotiate. At the same time, productivity growth hasn't kept pace. Technology is advancing, yes, but its benefits are unevenly distributed. Some sectors surge ahead while others stagnate. That creates winners and losers and social tension. Markets don't like instability. Capital doesn't like uncertainty. When trust weakens, investment slows. I've seen this before. In the late 1990 seconds, optimism blinded people to fundamentals. In the mid-2000s, leverage hid risk. Today, complexity is doing the same thing. Financial products are more sophisticated, markets are faster, but human behavior hasn't changed. Greed, fear, denial, they're constants. Here's a shocking fact most people don't know. A relatively small shock can trigger outsized consequences when systems are tightly connected. A regional banking issue, a geopolitical escalation, a policy mistake. In a highly leveraged environment, small cracks spread fast. Liquidity disappears. Trust evaporates. And suddenly everyone is asking who's exposed. Think back to 2008. The problem wasn't just housing. It was confidence. Banks stopped trusting each other. Credit froze. Businesses couldn't roll over short-term funding. Ordinary people lost jobs not because they did anything wrong, but because the system seized up. Today, the system is even more interconnected. Technology has sped everything up. Money moves instantly. Fear spreads faster. Algorithms react before humans can think. That means corrections happen at a pace most people aren't prepared for. There's less time to react, less time to adjust, less time to learn. And here's the part that worries me most. Many of the traditional shock absorbers are weaker. Central banks have already used many of their tools. Governments are already heavily indebted. Political polarization makes coordinated responses harder. The margin for error is thin. Meanwhile, markets are priced for perfection in many areas. High expectations leave little room for disappointment. When reality falls short, repricing is brutal. I've spoken to pension managers who are quietly adjusting assumptions, to insurers stress testing extreme scenarios, to CEOs delaying investment because visibility is poor. None of this makes headlines, but it matters far more than daily market moves. Ordinary people feel this in subtle ways first. Job insecurity, higher monthly payments, savings that don't stretch as far, anxiety about the future. These are early warning signals, not anomalies. The media often frames this as a series of isolated problems. Inflation here, housing there, rates somewhere else. That framing is wrong. This is one system under strain from multiple directions at once. And systems don't break where you expect. They break at the weakest point. I've seen families do everything right. Work hard, save consistently, avoid speculation, and still get caught in downturns because they didn't understand how exposed they were. That's not a failure of character. It's a failure of information. This is why I'm being so direct. Because what's happening right now isn't a temporary wobble, it's a transition from a world of easy money and assumptions to a world where discipline matters again. The question isn't if something changes, the question is how prepared you are when it does. Because once you see the full picture, once you understand the forces at work beneath the surface, you start to realize something unsettling. The story most people are being told is not the real story at all. Here's what they don't want you to know. The public narrative is designed to keep you calm, not prepared. When I'm in private meetings, this is what we actually discuss. Not whether growth will be strong next quarter, but whether the system can absorb another shock without something breaking. Not how to reassure markets, but how to manage fallout if confidence cracks. These are not conversations meant for headlines. They're contingency conversations. Quiet, serious, and very real. The public is told that inflation is under control, that markets are resilient, that any slowdown will be soft. Those words sound comforting, but they hide an uncomfortable truth. Many of the biggest risks right now are structural, not cyclical. Structural problems don't fix themselves with a rate cut or a press conference. Let me explain this simply.
For years, growth has been pulled forward by borrowing from the future. Governments promised more than they could sustainably fund. Corporations optimized for short-term gains.
Consumers filled the gap with credit. Everyone assumed tomorrow would be richer than today. That assumption is now being tested. Behind the scenes, institutions are quietly preparing for scenarios they publicly dismiss. Banks are tightening lending standards, even while saying credit is available. Asset managers are increasing liquidity while talking about long-term optimism. Companies are freezing hiring plans while projecting confidence. This disconnect isn't accidental, it's risk management. When I sit with wealthy families and large institutional investors, they aren't asking, how do I get richer fast? They're asking, what could go wrong? That alone should tell you something. Capital preservation has quietly become more important than capital appreciation. Another hidden truth, governments are far more constrained than they admit. High debt limits options. Political division slows action. Demographics reduce flexibility. In past crises, there was room to maneuver. Today, every solution carries side effects. Print too much money, you risk inflation. Raise taxes, you risk slowing growth. Cut spending, you risk social unrest. There are no easy answers left. So instead, leaders choose language. They choose optimism. They choose delay. And here's the uncomfortable part. Many policies now are designed not to fix the problem, but to manage perception. As long as people believe things are stable, systems hold together. Once belief fades, reality accelerates. I've seen this play out before. In 2007, problems in housing were described as contained. In 2008, they weren't. The gap between what was said and what was happening destroyed trust. And trust, once lost, is very hard to rebuild. Another truth most people don't hear: inequality isn't just a social issue, it's a financial risk. When too much of the economy depends on people who are already stretched, consumption becomes fragile. One shock, and spending collapses. That feeds back into earnings, jobs, and markets. It's a loop, and loops can spiral. Wealthy investors understand this. That's why they diversify not just assets, but jurisdictions. They think globally. They spread risk across systems. Meanwhile, the average person is often concentrated: one job, one country, one currency, one housing market. That concentration feels normal until it's dangerous. Here's another myth worth exposing: that complexity makes the system safer. People assume sophisticated models and technology reduce risk. In reality, complexity often hides it. When too few people truly understand how something works, accountability disappears. Problems grow unnoticed until they're too large to ignore. And let me be very clear about something. This isn't a conspiracy. It's incentives. Leaders are incentivized to avoid panic. Institutions are incentivized to protect stability. Markets are incentivized to keep moving. No one wakes up wanting a crisis, but crises emerge when incentives misalign with reality. The wealthy aren't smarter. They're just more cautious. They ask different questions. They assume volatility is normal, not exceptional. And right now, they are quietly positioning for disruption, not continuity. That doesn't mean they're all selling everything. It means they're building resilience. Indicates a shift in mindset from how much can I make to what can I afford to lose. Most people are never taught to think this way. They're taught to optimize returns, not survive shocks. That's a dangerous gap. The public is also told that technology will save us, that innovation will smooth transitions, and while technology creates enormous opportunity, it also creates displacement. AI, automation, digitization, these forces increase efficiency, but they also compress timelines. Change happens faster, disruption hits harder. There's less time to adapt. When change accelerates in a leveraged system, mistakes compound. I want you to understand something deeply. The next phase won't just reward intelligence. It will reward preparedness, emotional preparedness, financial preparedness, psychological preparedness. Most people wait for certainty. But certainty never comes before crises. It comes after. By the time something is obvious to everyone, the opportunity to protect yourself has passed. So if the public story feels reassuring, while your personal experience feels stressful, trust your experience. Rising costs, job uncertainty, anxiety about savings. These are signals, not personal failures. Signals. What I'm really trying to give you here is not fear, but clarity. Because clarity gives you agency, and agency is power. Once you see the hidden truth, once you understand why the messaging doesn't match the preparation happening behind the scenes, you start asking a different question. Not will things be okay, but what am I doing now to make sure I'm okay if they aren't? And that question leads us to an uncomfortable but necessary place. Because the hard truth is this: most people won't fail because the system collapses. They'll fail because they never adjust their behavior while they still had time.
Most people won't fail because they're lazy or unintelligent. They'll fail because they keep doing what used to work in a world that has already changed.
I've been in this business for over 40 years, and this is one of the hardest truths to accept. Financial failure is rarely sudden. It's slow, quiet. It happens through small decisions repeated over years. Decisions that feel normal, comfortable, safe, until suddenly they're not. The first reason most people will fail is denial. Denial is powerful. It whispers this doesn't apply to me. It convinces people that warnings are exaggerated, that problems will be fixed before they personally feel the impact. Denial buys emotional comfort today at the cost of pain tomorrow. I've seen this pattern before, and it never ends well. People wait for absolute certainty before they act. They want confirmation, they want proof, but markets don't give polite warnings. By the time certainty arrives, prices have already adjusted, jobs have already been cut, and options have already narrowed.
Another reason people fail is lifestyle inflation. As income rises, spending rises faster. Bigger homes, newer cars, monthly commitments that quietly lock people into fragile positions.
Most people don't realize how vulnerable they are until cash flow is interrupted. And when that happens, flexibility disappears overnight. Here's what the wealthy do that the middle class doesn't. They protect optionality. They design their lives so they can absorb shocks. They don't build financial plans that require everything to go right. Most people do. Most people make this critical mistake. They confuse income with security. A good paycheck feels safe until it isn't. Jobs are not assets, they're agreements. And agreements can change quickly when conditions tighten. I've seen highly skilled, hardworking people blindsided because they assumed their role was indispensable. Another major failure point is overconfidence in institutions. People assume pensions will be there, social systems will hold, governments will step in. Sometimes they do, sometimes they can't. And sometimes the help arrives too late or with strings attached. Counting on external rescue is not a strategy, it's a hope. Then there's the psychological trap of short-term thinking. Humans are wired to prioritize today over tomorrow. That's normal. But markets punish that instinct. People chase what's hot. They buy when things feel safe and sell when fear peaks. This behavior destroys wealth slowly. Then all at once, I've watched ordinary investors panic at the worst possible moments, not because they're foolish, but because no one prepared them emotionally for volatility. They were told markets go up over time. They weren't told about drawdowns, job losses, or forced selling. So when stress hits from multiple angles at once, rational thinking disappears. Another reason people fail is concentration. One income source, one asset, one plan, one assumption about the future. Concentration feels efficient until it's catastrophic. Diversification isn't about maximizing returns. It's about surviving uncertainty. That lesson is often learned too late. Let me be a little direct here. Comfort is the enemy of preparation. When life feels manageable, people stop questioning their exposure. They stop learning. They stop adjusting. But risk doesn't disappear because you ignore it. It accumulates. I've also seen people fail because of ego. They don't want to admit they don't understand something. They don't ask questions. They follow the crowd. They outsource thinking. In a stable world, that might be fine. In a transition, it's dangerous. The wealth gap keeps growing, not just because of money, but because of behavior. Those at the top adapt faster. They seek information early. They plan for multiple outcomes. The middle class is encouraged to stay passive, to trust, to consume, to wait. And waiting is expensive. I want you to hear this clearly. Doing nothing is a decision. And in periods of change, it's often the worst one. People also fail because they focus on returns instead of resilience. They ask, what will make me the most money? Instead of what will keep me standing if things go wrong. That difference in framing changes everything. I'm not saying this to shame anyone. I'm saying it because awareness creates choice, and choice creates power. If you keep assuming tomorrow will look like yesterday, if you keep building obligations without buffers, if you keep ignoring signals because they're uncomfortable, then yes, you may survive, but you won't be prepared. And when stress hits the system, unprepared people don't get choices. They get consequences. Now, let me pause here, because this is important. Everything I've shared so far is for educational purposes only. This is not financial advice. I'm not telling you what to buy, sell, or hold. I'm sharing perspective, experience, and principles shaped over decades in global finance, so you can think more clearly and make better informed decisions for your situation. What you do with this information is up to you. But if you remember nothing else from this video, remember this: the greatest risk right now is assuming you have more time than you actually do. Preparation doesn't require panic. It requires honesty. And it requires action before action feels urgent. If this conversation made you stop and think, if it challenged assumptions you've carried for years, then stay connected to this channel. These discussions take time, research, and effort to bring to you with clarity and seriousness. Share this message with someone who needs to hear it. Tell me what part made you uncomfortable or made you reflect. And if you believe understanding money is essential for protecting your future, support this work by subscribing, because awareness shared early can change outcomes later. And the next part is where we shift from hard truths to what actually works in times like these.